Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? Phil Tarrant, host of the Smart Property Investment Show, recording very chilly winter's morning in Sydney. It's certainly arrived, the winter, and just recording after the long weekend. And I know a lot of people have used that as an opportunity to sort of recharge after a pretty busy start of the year. But here we are halfway through 2025. We're just looking down a barrel of 2026. That's the time when a lot of people start really thinking about at the close of the tax year, what their portfolio is looking like. It's when they may get some rude shocks when they do their financials and a portfolio they thought was moving in the right direction and delivering a fair bit of money in the back pocket might actually be providing the other that is negative when you're thinking it's positive. A lot of people also invest in trusts and they feel as though that's a good way for them to keep building out their portfolio, and they find when they do their tax come the end of June, it's a very different situation. So good luck with that. Make sure you're working with your accountant through that process. However, what is key and critical is that you don't want rude shocks in your portfolio, and a portfolio that goes up and down and left and right and is not very sustainable or has little continuity in terms of predictability can be a challenging portfolio. Yes, you can get some wins along the way, but it could be quite messy as well. So that's the reason why a lot of property advisors talk about building sustainable property portfolios or sustainable property investing. One of them is Kev Tran, who joins me in the studio. He's the director at Kev Tran Group, which I'm going to call KTG because it's too much of a mouthful. Sustainable property investing. We're going to have a chat about today. Kev, how you going?
Good, Phil. How are you,
Welcome
mate?
back.
Thank you. Thanks
Good to see you, mate. What's been happening? It's been a little while, but it's regular guest on the show, and a lot of people appreciate your insights. You always get good feedback on the podcast that you come on. You guys been busy?
Appreciate that. Yeah, been busy. Yeah, the business is growing, but just like any other business, we're just trying to make sure we can manage all that and I guess grow sustainably.
You need sustainable, right?
Yeah.
Why is sustainability so important, do you reckon?
I guess for me, like the philosophy always comes down to like why we're doing all this. Like why am I doing the business? Why are we investing in property? I want to get to a stage where I've got less stress. Like obviously understanding when we're building the portfolio, we've got more leverage and all these things. We're going to have a fair bit of stress along with it. But effectively, I want to get to a stage where we can, buy back time, have the financial security. And to me, like building the business is the same philosophy with my personal portfolio. I don't want to juggle too much and not be able to sleep at night. So
fair enough.
That's the main thing. We want more money and more business, whatever it is, but at the same time, like it's okay to not be number one in the world and all these things. So
yeah, and you need to have a comfortable, rational, internal discussion with yourself around what you actually want. Yes, you can grow a very big property portfolio, but it's probably going to be all-consuming and probably not always going to go in your favour, and it's going to be lots of things to manage and control. The same thing applies in business. You get to make that choice. I know a lot of people in business sort of you get fatigued with being responsible all the time, and to your point, sort of making sure it's sustainable and getting back time is key.
Yeah, absolutely. So that's the main thing.
So let's talk about your portfolio. You've been investing for quite some time now.
Yeah, so invested for first property back in 2016.
Okay.
So we're about 9 years in now. 4 properties in a position to scale, so like quite a lot. Last few years in business, obviously in the first few years, getting financials and everything can be a bit tricky. But obviously been reinvesting quite a bit to the business as well. And the conundrum that I've had in the last 12 months is now that my income is strong, I want to scale, but also where do I fit into the queue with all my clients as well?
Oh, yeah, God.
Yeah. So we ended up buying one, and I was actually the backup to a backup. A client couldn't move in time, and yeah, I jumped in there.
You often find that, I see that with buyers agents, they typically pick up the deals that fall apart, which they're a bit too curly for most people, or for some reason they fall over at the 11th hour, and you can sort of jump in there and pick it up because you do deals with real estate agents, and your relationship with real estate agents is key. You don't want to start burning those bridges, right? So sometimes that's the good opportunity to actually get in and still buy.
Yeah, exactly. And we can get into some of that as well in terms of like how we do deals and everything as well, like that. But yeah, that's kind of my internal dilemma. I'm like, do I even engage another buyer's agent? because then there's no kind of sort of conflict.
You know what? It's actually not a bad idea. Who would you choose if you're going to choose another buyer station? I'll put you on the spot.
There's probably a handful out there, but I don't want to get there.
No, I'm not going to ask for a name, but that's the point, right? There is, it's a booming industry in many ways, buyers agency, and there's very good operators around, yourself included. And I think you were first on this show when you were a property investor back in the day. Is that right? Is that the original story?
Yeah, exactly.
I feel like I've known you for years.
It feels that way, doesn't it?
So this concept of sustainability, that will mean different things to different people.
Yeah.
I guess a sustainable portfolio, you would think, shouldn't be too contingent on having to do things to it all the time. It should just be set and largely, because if you build it the right way, it should be able to deliver and be self-sustainable. And imagine sustainable being a view towards cash flow. Would that be a fair point?
Yeah, you're right in the sense that it can mean different things to different people. So I guess the idea today, we want to clarify that a little bit in terms of what it means to me.
Yes.
In the philosophy that we have. It definitely doesn't mean that we are looking at, like the environmental factors and being sustainable in that sense and what the house is built of.
As in like as a greenhouse. And,
even though that's actually something that we factor in with due diligence, which we can talk about. But what I mean here by sustainable is what's something that you could stick with to the long term and get you to that long-term goal, and you can have confidence behind hitting. You know what I mean? Because you don't want to have too aggressive a plan, for example, where you start building the portfolio and you're acquiring and you go, it's all good, but you're not managing the cash flows properly, and then you end up having to sell a property. So you take a few steps back because of all that. There's so many costs involved when you transact. Like, you ideally don't want to sell unless you really, really want to. Part of your exit strategy, whatever it is. So I can go down the few aspects of it. So firstly, it's creating a strategy that suits your goals and what's important to you. And for everyone, that's going to be a bit different. Not everyone wants to build a 10, 20 property portfolio. Some people really want that passive income. Some people, maybe they're nearing retirement already, and realistically, building passive income may not be, like a high thing for them. It might just be like I can sell down some of the properties and live off the profits. Along the way, we'll talk about market research. So when you're choosing markets even to invest in, like what does that mean by being sustainable? Once you're in those markets, how do you choose assets? How do we choose a property that's going to perform for us long term? Because you can definitely find good suburbs to invest in. Your Fast 50 recent episode was really good to talk about that. But within those suburbs, choosing the right property is also another element, right? So how do we do that sustainably? And it's not going to be cause issues for us down the track. So these are the things that we can talk about when we talk about being sustainable.
And I guess that's the strategy around sustainability. And what we're talking about here is the concept of sustainability. And if that's something you subscribe into as a property investor, that's a decision you need to make. And I would imagine most property investors want a sustainable portfolio, because sustainable to me means it has continuity. It's when you're having to sell down assets because for some reason it's not working. It's not a sustainable portfolio. So it should be self-generation, self-manufacturing. And a lot of people and I'm big on perspective for property investment. And we did a big sort of SPI, reader survey or listener survey or viewer survey, whatever and however you're engaging with this. And please keep those reviews coming wherever you're doing that. But it was a recalibration for me to actually go, hang on a second, like, because you sort of operate in and around property all the time, you think property investors are a particular sort of way. And these are people with massive portfolios and super active and doing deals all over the joint. That's not what most property investors are. Most property investors between 1 or 2 investment properties, and then you get some outliers and they start getting 3, 4, 5. And then one end of the spectrum, you've got people with huge portfolios. However, this idea of huge portfolio gets normalized and people sort of start banning around sort of 30 properties before 30 or 100 properties. Like, I don't know how many people with 100 properties, but I doubt there's many, right?
That's right.
Yeah. And you work with clients, like how many of your clients would be looking to grow a 100 property portfolio? I'd probably doubt that's not on the the regime of a lot of the people who you're actually working with, because people who you're working with probably have a bit more education about themselves, that they know to do that is very, very hard or nearly impossible to do so. How do you think we promote this concept of sustainability? And sustainability for some people may be really boring versus this idea of, hey, 30 properties by you're 30 years old.
Yeah, I think like it's not anyone's fault as well, because there is so much noise out there. You listen to podcasts, and like you said, there are these individuals in the space who have achieved amazing things in terms of volume, and you look at that and you compare yourself and you go, man, like how do I need to be doing that to be a decent property investor? I think the main thing is looking at what you're doing this for. At the end of the day, you know what I mean? For a lot of people, like I said before, it might be, hey, I really don't like my job. It pays well, kind of don't have any other options now. I want to keep working in that role, but I want to eventually at some stage work part-time, or I want to stop work altogether. So, okay, cool. So some people, passive income might be a real thing for them. Genuinely, like they're serious about it. Some other people might just be like, hey, I've already got my primary residence. I've got 2 kids. We're in our 40s. We just want to be able to build a pretty comfortable portfolio where, we aren't relying on the pension when we retire. So kind of like breaking down what's important to you at the end of the day, and then your current circumstances too, because we don't all start at the same place. You know what I mean? Some people live at home and they're in their early 20s. Also make the most of that. Some people, like I said, already have a family home. They've got a couple of kids. They're starting off in different places. So having a conversation, being serious about how important this is to you is the kind of the first step. And from there, how I work with clients as well is we then break down, like, for most people, it's quite possible to maybe buy 5 properties over, like maybe the next 7 years or so. We can kind of work out what that looks like for them. And when they retire, maybe they don't need all 5. Maybe they could sell 1 or 2 of them and reduce debt, and that could be a pretty good portfolio for them in terms of what it provides in terms of passive income. Yeah. And even if they were to sell down and have profit to live off, that's pretty good. Some other people want to achieve more, and they've got the servicing to do that, and maybe they want to go into commercial as well. So there's all these things that we can start talking about to see if it's actually suitable for people. I've got clients that don't want to buy multiple properties. They want to buy 3 and maybe pay them down very slowly with principal and interest loans. Right? I wouldn't do that, but if that's what they want to do, if they're comfortable doing that, hey, that's at least you know what your options are. I've got other clients as well who are now looking at commercial. They built a residential portfolio and they want to go, a bit harder on that side. So that's what I mean by understanding, what is suitable for you, and then kind of working at that path.
And that's the critical thing, not making your decisions off other people's situations, and it's easy to get to the point of trying to compare yourself with other people, but being able to be clear of thought and actually determine what is the outcome that you want and plan around that. And for most people, it's going to be a lot more subdued. There's some huge ambitious goal of maybe creating 100 property portfolio, and it's also going to be dependent on where you are in your investment journey. How familiar with this term now? And you must see that. So you obviously have rent vestors, as in I rent and I invest. There's this sort of concept of stay vestors, where you stay at home with mum and dad and you invest. So it's an iterative version of a rent vestor, but you're not paying any rent. Yeah. Do you see a lot of that in your client base these days?
Not a lot, no. But we've got a fair few.
Yeah, I don't know how happy I am with the term. I don't really like rent vesting either, but stay vestor is in. But that's it's not a bad way to get going.
Yeah, like, I mean, again, whatever your circumstances are, understand what your options are, and that's definitely a great way to do it. Like, if you're living at home, you're not paying rent or very minimal, you've got a lot of opportunity there to start building your portfolio. You've got excess cash flow that you can reinvest, and something to look at. We don't have too many of them. I find that we've got a fair few, let's say they're in capital cities like Sydney, Melbourne, living at home with parents still because it's really expensive.
Yeah.
And they want to make the most of it. So we can guide them through.
I reckon that's a good way for the parents to give back rather than sort of giving hands out in cash or going guaranteeing a loan. Just let them stay at home and let them be a stay vested. But anyway, it's time for another podcast. So I get the idea of sustainability. It's going to be difficult, I think, maybe to conceptualize that, what it is in isolation if you're not, or you don't have a lot of experience in property investing. So no doubt having a good team that actually understands what your version of sustainable is to help you shape that is pretty critical.
Yeah, definitely. So it's been talked about a lot, having a strong team. You really need a strong broker on your side. And when we say implementing your team, definitely someone who either has done it themselves or has done it for a lot of clients in the past, so that they understand different pathways to get there. And hopefully one of those pathways is something that aligns with what you want to do as well. So that's key. Having a good accountant as well, as you start building the portfolio. And, if the question, as you're doing the strategy, it's like, well, is buying out a trust suitable for me, or personal name and all these things? You want to have a strong team that you can rely on that's, again, done it before,
How do you go when you're working with your clients and they may introduce other people of their team, existing relationships, accounts, for example, and you sit there and go, oh, this account's not very good, or they don't really get it, or they're not very experienced in property investment? Do you run across that very often?
Sometimes.
Yeah.
Sometimes.
How do you deal with that?
Have a real genuine conversation with clients, and I always say to them, I can work in with anyone that you already have in your team, and we can talk together on whether or not you feel that they are good for you, or at some stage you should fire them. My first mortgage broker was a family friend referral. I didn't know any better. They did the job, great, but they could have very easily told me about LMI, and I would have bought an established and not off the plan build. I was like, that's so basic. I wish you're the only person in my team, would have told me that. So I can have a conversation with clients and be like, hey, how do you feel about your broker? How do you feel about your accountant? And sometimes they'll tell me, they've just been the family person we use, and I'm happy for a recommendation. Like, cool, we can do that. But if we have a conversation, they're like, they've helped me with this and that. They're really knowledgeable. Yeah, great, we can use them. I like to connect with them as well, because obviously as a strong team, you want to be able to work together. So I can let clients know if I feel that they are maybe not the best fit.
Yeah, it's interesting, and you find as you're investing in property, you outgrow your advisors, right? You just naturally do it depending on same things happen sometimes in business, and that's an okay thing. You just got to be conscious and aware of it, and that also comes down to supporting this idea of building a sustainable portfolio. But conceptually it makes sense, but how do you go about doing it? What's the right strategy for you for building a sustainable portfolio? Let's get stuck into that, Kevin. We'll just go to a break beforehand. Stay with us, everyone. We'll be back in a moment. Welcome back. Phil Tarrant, host of the Smart Property Investment Show with Kev Tran from KTG. That's a Kev Tran Group. Sounds big.
Yeah. There's 7 of us now.
Wow, there's 7 people.
Yeah.
No.
So we doubled our account since the last time we've been here. So
really,
we're almost a year now in business. So
you've got 7 people in only a year in.
Got to find the actual date of the anniversary, but yeah.
It's pretty cool. Are you happy being in business for yourself?
Definitely. At the end of the day, yes. But I've got to be truthful. There's a lot of headaches. There's a lot of stress. So I'm trying to mitigate that by,
bringing people in.
before we need them, getting the right clients on board. And this, I guess, the podcast as well, this episode, wanting to help people cut through the noise that's out there. But also, if you're going to choose a buyer's agent to work with, I'm not saying work with me or definitely other people out there, some really good operators that I would use myself, is also just be realistic with what to expect. Using a buyer's agent shouldn't be like this person that's going to find you a unicorn that's going to perform 50% in a year. We've had the COVID boom. We've had some pretty interesting times recently. It can skew a lot of expectations. It's hard to buy. That's the truth behind it. And if you don't buy well, sticking with a clear due diligence process, which we do, it's not quick, So anyone listening out there that may engage us, we'd love for you to reach out, but also, we'll talk about what to expect and all that stuff.
And that's pretty important, because the way in which sometimes buyers agents would present themselves on social media is the immediacy of saying, hey, look how effective we've been at buying this. We bought it for X and sold it for, and now it's worth Y, or we bought it 12 months ago and look how much it's grown, right? You get all that sort of stuff. So therefore it builds in this expectation of, the accelerant nature of property always outperforming other asset classes, and that's not the case. So properties all perform, depending where you're buying, in very different ways. So back to the sustainability, if you go into thinking that your property journey is going to be buying properties that grow by 50% every single year and you're going to do that for 5 or 6 or 7 properties, it's probably not going to happen. Sorry to deflate people's sort of view of how it's going to perform. It doesn't move that way, and they are absolutely outliers. So when you do engage someone, you need to be absolutely sure that, if you think you're going to get unicorn deals all the time, that means every single person wants unicorn deals. They just don't exist. So anyway, but how do you actually fit the right strategy, Kev, to yourself with a view towards sustainability? How would you go about doing that?
Yeah, so firstly is understanding what your financial position is at the moment, right? So when you've got that team, speak with your broker, understand what is my borrowing capacity, how much cash do I have now? Am I starting off with equity? Like, do you have a primary residence and there's a bit of equity there already? And then also your cash flow. So these are the main things when we talk about your financial position, because they will dictate what you kind of can do in the short term and what sort of portfolio you can hold as well. Because unless you're putting in like a 40% plus deposit in most cases, everything's going to be negatively geared. I'm talking about residential property here. So you need to have excess cash flow to hold on to these assets. So when you're kind of working out a strategy for yourself, is factor these things in with your broker. At some stage, it doesn't matter who you are, everyone's income will then kind of dictate your borrowing cap at some stage. So then you can work out, all right, cool, other ways around that. Do we need to engage an accountant to be a bit more creative with our buying entities and all these things? So that's the part when I work with clients, just to like map out all these things. If a client actually has a really big goals, they're like, I really want to build a big portfolio. I know servicing is going to be a cap. I want to speak to someone about buying under a trust at some stage, whatever it is, then we'll connect them to that person and at least have that conversation. But I can give them some general things about pros and cons. And when I start telling them about all the setup costs and everything like that, a lot of people go, probably not for me.
Most people shouldn't be investing in trust, initially at least. And people get caught up with it, and they set up trust from day one, and it gets complicated, and it's a headache, and they're not comfortable dealing with it, and like it can be a big deal, right?
Yeah, and to the point of yours before, like there's a lot of content out there nowadays. It gets people excited about doing different things. So people ask me all the time, like, should I buy under a trust? And that's when I can give some general kind of ideas about, what I see. But if they want to get advice around that, we'll connect you with a property savvy accountant that can run through. And then often they'll be like, yeah, it's not for me, but it's something that we want to talk about.
And you got to make your own decisions on stuff as well. Just because someone tells you should do something, advise, it doesn't necessarily mean you have to. You've got to interrogate it and stress test it. But you said something really important there, and this is talking about building a sustainable portfolio, and whatever your concept of sustainability is. Yes, you can have a positively geared portfolio if the LVR is at a level which allows it to be positively geared. So, this notion of starting today and building instantly a positively geared portfolio in residential property is largely impossible to achieve, unless I think you said, unless you're putting 40% down rather than 20% down as
at the very least.
At the very least. So, sustainability means you need to be able to service the negative aspects of that portfolio, and that I would imagine would be a critical point for people to appreciate at the front end. How much spare capital do you have to tip into servicing your debt repayments while you wait for the capital growth to take place?
Yeah, exactly.
That's critical.
Yeah, that's critical. Even for the first one, like, can I even hold this one? And further to that, do you have a safety buffer after the purchase? So after you make this purchase, do you have enough funds as an emergency, whatever that might happen, personal or property, unexpected maintenance costs. So we can work out what that looks like. But from there, talking with a broker, talking about that total borrowing capacity, and then we can start mapping out like, hey, you can actually buy multiple properties over the next few years. If we're limited with one thing or another, like for example, you're limited with the initial equity or cash, then we might need to wait for this first one to grow so you can leverage that, So that first property, and we can talk about locations in a minute, but like then we might need to only look at areas that are experiencing strong supply and demand pressure now, because then it's a short amount of time you need to wait before you can leverage the equity. you know?
So in building a sustainable portfolio, how much do you need to think about, all the what ifs? And you talk about building a buffer in there, but, there may be some structural what ifs, as in you don't have your job anymore or you go from 2 incomes to 1 income, or you start having dependents and therefore life gets a lot more expensive. How do you factor those things in? Which are the sort of, some of them are known unknowns, some of them are unknown unknowns. How do you build a sustainable portfolio when there's often a lot of things you can't really have control over?
Yeah, exactly. Good point. So a couple of things there is you want to have enough financial buffer for that emergency fund. And for everyone, it's a little bit different. So typically when I work with people, I'll share what I do. And then part of that conversation, talking about like referring to different people in their team, if they really need help with budgeting and they're not sure about other aspects, then I'll recommend them to a financial advisor.
Yeah.
Because you need to get, like I work with one personally and it's been a game changer for a couple of points and I'll mention, which I didn't even know about. So budgeting is for one thing, but also insurances. So I didn't know there's a whole bunch of different type of insurances. Previously when I was a PAYG, like a full-time employee, I think you got like standard insurance through your super.
Yeah, that'd be life insurance or DPD.
Yeah. But I found out they're pretty like crap, depending on which super fund you're with. So with my financial advisor, we changed the different insurers. We could really fine tune what sort of coverage we wanted. And there's also like one, I think it's like trauma or something like that. Don't quite remember. But if, for example, if yourself or someone in your family gets diagnosed with cancer, then you can get
the TPD. So sort of this is your crook for a period of time, and you're insured around it. Yeah,
but even like it's another one as well outside of the TPD. It's like I think you
could be trauma insurance.
Yeah, you get diagnosed, and it's like boom, you're covered. Definitely look into it.
Yeah, you got income replacement as well.
Yeah. So there's a whole bunch of different insurances you can get. It's going to help you for that. When you buy your property as well, this is separate. You can get obviously landlord's insurance, coverage for loss of rent and all these things. So depending on your risk appetite, some people don't care for that. Some people makes them feel more comfortable. So these are all things you look at. For me personally, that safety buffer aspect, I work off 6 months expenses. And I work off my personal expenses because they're higher than my portfolio, So, my rent, my living costs and all that stuff, I work at 6 months. So I've always got at least it's like 80K or something that I never dip underneath, For some people it might be more.
And that would sit in an offset account somewhere.
It sits in an offset account, you've got additional funds there. Obviously it's offsetting the interest you're paying, but also it's liquid, you can access it whenever you need. So that's what I do. Some more aggressive investors might be like 6 months, like 3 months is enough for me. Some people who live at home especially, they're like, I don't need anything, So it's different for everyone. But yeah, you want to have these things before you start mapping out and buying the next one.
What's your view on always sort of bring in when you sort of start investing and you're looking to rapidly grow, always sort of keeping liquid funds in offsets against the debts that you have. So if you do have increase in equity, always leveraging back up to 80% and keep money in those offsets ready to deploy as and when required, and or using those funds as your potential surplus to mitigate any challenges that you have. So if it's sitting in your offset, it means you're not paying any interest on it, right? However, if you keep ratcheting up your LVRs to 80%, you're going to dilute your serviceability to keep investing over time. Where do you sit with all that?
Yeah, so there's a balance as well. So in the beginning, when you're in the accumulation phase, you want to be growing your portfolio faster. For me, as long as you've got the buffer in place, then you can go again. Yeah, refinance. And I think as a property investor as well, it's probably a good habit to have every 12, 18 months review your portfolio, especially if you've got your loans on interest only. They're only fixed for a certain period of time, so you've got to be looking at them anyway. Yeah. But then you can be on top of interest rates, but also markets all move in different cycles. So then if you've got one of your properties that are doing well right now, then refinance. A good example with mine was my property in Ballarat in 2022. It went from like 385 to like 600. Right, so I refinanced that, parked some in offset. I didn't use it for a little while. But now like Ballarat in the last couple of years has gone down a little bit. But I refinanced when it was doing well. That money's been sitting there ready for when I need it. So it's a good habit to constantly review your portfolio anyway.
Yeah, which means that you've always got to be ready to get finance done, which means if you're self-employed, you've got all your financials set up. And just having really good sort of, administrative capabilities and everything stored well, and which is really important, right? And no doubt if you sort of need support with that, Kev can help you out with that. But did you have a view on, building a sustainable portfolio? This idea, a lot of people say don't have a principal place of residence, PPOR, because it will limit your ability to invest in property because it's going to really cap your serviceability. The point being that a lot of people max out their serviceability just with a nice big principal place of residence, which means that they're stifled for some time unless they get equity growth to invest outside of that principal place of residence, and or they can't change your income position. So therefore, that's it. PPOR, do you like the idea of having them as an investor?
So I'll probably dive a little bit deeper into that, and I'll try not to ramble on too much. But
from a strategic point of view,
it is a massive anchor on your servicing. Yeah. Right? I think most people will agree on that. The banks look at it as a liability. It's non-tax deductible debt. It's just not fantastic for building wealth. Yeah. However, when we're being sustainable, we need to look at the whole overall aspect of your life. If you have a growing family and you're very stuck in it, not stuck, I shouldn't say, you've got family in a certain area, schooling, all these things, and you want that stability, it's important. You can't overlook that, right? But I think a few aspects you want to look at is if it's a house, great. I wouldn't go and buy a primary residence if it's an investment. So if it's an apartment. Okay. Unless you really see yourself living there for a long time and you're doing a lot of checks to make sure it's a good developer, good build, and all these things. But
are you talking about a big sort of off the plan type thing, or?
Oh yeah, really? Even like most, unless it's like it's a pre-70s full brick, low dwelling, like a block of 6 or 12 units. Walk up. Most apartments in Sydney and across Australia they have water ingress issues, strata levies, all these things. My mum and I copped it when I was like 16. Massive, special levy, and that wiped her out. And so, I think be really conscious about that. But yeah, if you've got your primary residence, that's fine. Just don't keep upgrading all the time.
Just leave it.
Yeah, just leave it. If you have the stability, but then start building wealth, because people get the taste, they want to upgrade all the time. And what that means is you've got stamp duty every time and all these things. So that's something to be conscious about.
Yeah, and this idea of always upgrading, people go, okay, well, we'll get a principal place residence, then we're going to have kids, then we'll get another one, then we'll get another one, and then they get to the point when they need to downsize it, right? A lot of people would say, well, it's a great way to create wealth because every time you upgrade, obviously you don't pay any capital gains tax, so therefore it's that tax-free uplift in your capital. However, the inverse of that is that every time you transact, you lose a bit of the value through real estate fees, and then you've got all the associated costs of buying again. And if you keep pushing up your principal place of residence, obviously stamp duty just keeps getting more and more and more. You must see that all the time, right?
Yeah, exactly. And also, if you're not buying investment properties, you're not buying properties that can bring you rental income and all these things. So yes, when you get to retirement, you can downsize, sell with capital gains exemptions, but you don't have a portfolio giving you income as well. So
yeah, it's so fun. I'm just looking through my phone just then because I saw a press release come through this morning saying apartments were outperforming houses in terms of capital growth. So, I don't yet know the specifics of that. You sometimes see that every now and then.
Yeah.
In
let's look at it. I think Brisbane's been doing pretty well with the apartment market, but then if you look at 25-year time frame, strata-type properties have way underperformed. So, yeah, you can probably pick and choose time periods for sure.
Yeah. So, principal place residence key. We spoke about unicorn deals, and when's the right time to get the commercial property? Do you feel?
I think after so typically we would like to see someone have a residential base first. Lower barrier to entry, but easier for lending, lower vacancy periods, typically with residential, and you can leverage that growth potentially into your commercial later. Or in that example before we talked about, let's say for example you buy 5 or 6 residential. Maybe at some stage you could sell 1 or 2 of them, take that cash, pop it into a commercial deal, for example. Why you don't want to go into commercial straight away is because the entry is much higher. I'm seeing decent deals like 1.3 mil above. Yeah. Because so much of the value is tied to the tenant and the lease. And then your lending as well, typically 30% LVR, so you can imagine that you need a big capital injection for that. And then vacancy periods can be longer.
Yeah, and that's why the leases are critical. And as you sort of get higher value commercial property, typically you start attracting a different type of tenant, corporate tenants who may have really long lease terms, right? And that's how you can really sort of manufacture growth. Because the idea of a sustainable portfolio and commercial, the concept there is the regularity or predictability of the income you're going to be generating connected to the commercial asset can be a great way for income replacement, right?
Yeah, absolutely. But then the big caveat to that is if you start off with commercial and then it becomes vacant,
You're stuck.
Now you got to sell or something, or you're stuck. So that's why we to be sustainable, you got to factor all that in.
Yeah, and to be sustainable, also you really need to have a view towards sort of long and short term goals, and a lot of that's going to come down to the sort of markets that you choose to invest in and how you go about researching those. So I want to get into that. Kev, conceptually, this idea of sustainability makes sense and building a strategy around it, but strategy is only as good as how well you execute it, and executing in property typically means finding good assets and then maintaining those assets and managing those assets. So that's going to come down to how you go about taking a view towards your investments from a short-term perspective. Long-term would be obviously capital growth and a view to sort of pay the debt down at some point in time so you can generate positive cash flow from it. But the short-term may be, I need to be investing in places which give the immediacy of very rapid, quick capital growth to enable a good accumulation phase in my property investments. So how do you go about doing that? Because it's really challenging. How do you get being comfortable with research? Yeah,
definitely. So two things, kind of our core philosophy is balancing capital growth with cash flow. We talked about the reasons why. You want wealth creation from the capital growth, but cash flow helps us hold the assets, right? So with residential, we are looking at purchase prices probably like 450 to $1 million.
Yeah.
And generally the yields there we see is like 3.5% to 5.5%. Right. So depending on what you would like in your portfolio, what you need, your personal borrowing capacity and all these things, that's when we can start mapping out like where is good for you and all these things. So typically the higher price you go, you're buying in areas that have stronger economies and all these things.
Yeah.
You're paying for that luxury. So to break that down further is we want areas that have strong economic fundamentals, not areas that are, have one or two key industries. That's too risky. For example, mining or tourism or something like that. So they're the areas that we need to look at. And the second thing is going to be the supply and demand pressure when it comes to how many properties there are. Areas with low supply and high demand, naturally, in the shorter term, 12 to 18 months, you can expect there to be some more capital growth that you can extract. And like I said, depending on what your strategy looks like, let's say, for example, you've already got some assets in your portfolio that are in those more heated regions, then maybe the next one you buy, you can go into an earlier market. The advantage there is you can negotiate a bit harder and you're there before the masses, so to speak. So when it does pop off, you're there for more of the next cycle. So there's no one size fits all, is kind of what I'm saying, but they're the elements that you kind of look at.
There's a lot of risks with that, but there's also opportunities. You think of places like Newcastle before the turn of the millennium. Newcastle was a steel town. That the football team was called that. That's most people were employed by the steel industry or the mining industry, and all the ancillary services was connected to people who chose Newcastle as their home in order for employment. Newcastle's changed a lot these days, and there's a lot of people who promote Newcastle, a really vibrant metropolitan location to invest in with a very diverse economy. It wasn't like that 25 to 30 years ago. So,
that's right.
How do you're still seeing places like that now in other parts of Australia who are probably transitioning? I would imagine that's sort of the headspace around sustainability, short to long term. You may need to carry it probably for some time before you see that transitional shift and huge uplift. But that's the art of research, isn't it?
Exactly. There's a thing that people often quote, which is like historic growth, right? They go, "Oh, this area has done, 4% for the last, if you look at the last 10 years, it's underperformed.
Average annual growth, 4%. Yeah.
Yeah, or they go, hey, it's 10% annual growth here. This is a really good location. But historic growth doesn't necessarily mean, it doesn't indicate future performance.
Yeah.
So that's a really good example of Newcastle, where it was previously really reliant on steel and coal. Coal was still a very big part of the economy there, but most people aren't employed in that industry anymore. It's quite diversified. And most people we speak to now would consider Newcastle one of the strongest regional cities in Australia. Metro even, people would start to call it.
Yeah. Right? I think the argument would be that Newcastle, parts of Newcastle metropolitan.
Yeah, you're right. So you've got that in many parts of the country. Right now, we're kind of I like to use this as an example because it's kind of the talk of the town for a little while now, but for good reason, which is Townsville. And people will go, hey, it's done its dash, it's a regional market, and it has its little peaks, and it's very volatile and all these things. And I would agree that regional markets as a whole can be volatile. Big part of that is when there is a lack of stability in the economy, right? Because if something happens in that particular industry, it's going to disrupt it, loss of jobs and all these things. So with Townsville, if you look at it, this decade, like from 2021 and now to 2010 to 2020, it was very heavily dependent on mining in the resources sector. So 2014 to 2019, when that industry had a lot of issues, there was a price reduction in the median house price there. Unemployment was around, I think it peaked at 11% at some stage.
In Townsville.
Yeah. Right, whereas now there's a lot of infrastructure. There's like $11 billion in infrastructure projects, whether they're underway or in the pipeline, across multiple industries. Most people aren't employed in mining anymore, and the unemployment rate's like 4%. It's also one of the regions in the country that has a lot of internal migration, so people moving there. So like you can't look at the 10 years it was before and be like, oh, that's how it's going to perform in the next 10 years because if industries are building up and there's people moving there for work and all these things, it doesn't go backwards. They don't just like stop, So you can't, it's not a fair argument to look at what it's done in the past if the economy is changing.
And that's where you need to identify all those different drivers. And you invest in Townsville? Or have you
Yeah. So my most recent is in Townsville. So it's done some pretty strong growth. Many suburbs have done 30% in the last 12 months. But like I said there, a lot of it isn't growth. Some of it's recovery growth.
Yeah.
And also you're still buying houses for like say 500 and something K. To rebuild that, it's going to cost you more in a lot of cases.
Yeah. Do you think it'll be sustainable moving forward, or it'll hit its peak and then be stable it won't move much for another decade?
Well, what I'm saying with Townsville, which reminds me a lot about another market that I invested in, which is Toowoomba. Toowoomba during COVID boom had a strong peak, and then I remember like 2023, people were like, "Why are you still looking at Toowoomba for?"
Yeah.
It's had already like 30-40% growth. I'm still buying there for clients. Obviously, you got to look at sub-markets and suburbs and all these things, but a lot of properties in the last 12 months have grown 15-20% still. You know what I mean? So it's the largest inland city after Canberra. It's only an hour and a half away from Brisbane. It has a lot going for it as well. So you can't just discount a market because it's had some recent growth.
Yeah. And you got to remember, you're reminded also just how big Australia is. Townsville, they say, is the capital of northern Queensland, right? Like Melbourne is closer to Brisbane than what Townsville is to Brisbane, right? Like it's a long, long way from anywhere, and it sustains a lot of diverse, different economic centres because it's large population. I know there's sort of like healthcare and construction, education. It's a garrison town as well. It's a big defence.
Yep.
A cohort up there as well.
Strategic port city.
Strategic port city. So there's a lot going on in Townsville and those type of areas. But it's absolutely critical to match your suburb locations and the assets you're buying with the long-term strategy you have towards building a sustainable portfolio. And my measure of sustainability, I think about my own portfolio is that I've never had to go, quick, I better sell everything because something's gone wrong. It's pretty much, it's rock solid. Yes, it has some nuances and there's times where it's a bit of a hassle and, I might not manage it properly and there's things I get irritated with, but by and large, it's a hugely sustainable portfolio because it's been bought well and it just continues to deliver capital growth and also had quite an uplift in rents over time. So what you'll find as a property investor is that, yes, your portfolio will be negatively geared initially, but at a point in time it'll become positively geared, and that's pretty important. However, your portfolio will become positively geared quicker if you stop refinancing it and pulling money out of it, because the more you keep increasing the debt, the longer it's going to be negatively geared, which is pretty key. Any other areas you like, Kev, sort of with a view towards, areas like Townsville? Anywhere else you think is doing well at the moment?
Yeah, so if I want to kind of simplify a little bit more, is like if you look at within 5 years, we had the COVID boom, right, where basically all markets grew. And then after the COVID boom peak, we had the aggressive rate rises from May 2022 onwards. So really interesting time. Even throughout that period of the aggressive rate rises, many areas kept growing, namely WA, Queensland and SA.
Yep.
Right. So then if you look at areas with the economic stability that we keep talking about, where there's decent affordability, good rental yields, where do you have left, New South Wales and Victoria?
Yeah.
So there's a fair few areas there that we're looking at that we like.
New South Wales and Victoria?
Yeah. So definitely, you can look at that. Bendigo's a good one. I kind of like definitely, I shouldn't say kind of, I like the Latrobe area in Victoria. Ballarat, I personally have one there. I'm still watching it because the data is still showing that it's declining. You're seeing a little bit of a recovery, but,
Would you reckon it'd be time to be back in Ballarat?
Yeah, well, I've got to keep monitoring it. Same with Geelong. These are really strong economic hubs, but the data is still showing that it's not recovering yet. So basically my whole thing when I talk to clients is you're either buying in an area that's growing now or you're early.
Yeah.
The question is how early do you want to be?
Yeah.
So I still reckon it's
okay to be too early if it's not a burden on your cash flow, if you can service that period of negative cash flow potentially, or you're not fulfilling the capital growth opportunities you may have elsewhere, but you are early, so you're going to get 100% of the upside rather than 60% of the upside, 50% of the upside.
If a market's kind of stagnant now, that makes a lot of sense. But if it's still declining, I'd still say be careful going in, because if it's still declining, you can probably negotiate harder with your prices, right? And that's where the term under market call comes in and all that stuff. But, there's something to watch out for. But in saying that, I wanted to be clear, don't just go out and buy anywhere in, say, Queensland, for example, because even though a lot of areas have that supply and demand pressure, they may not tick that first box that we have of strong economic fundamentals.
Yeah.
An example was Mackay. I got a lot of clients ask, hey, I think Townsville's done its dash. Can we buy in Mackay? Well, about, I think 30% of its economic output is in mining, and about 20% of the population is employed in that industry. So if something happens, I personally wouldn't be investing there. So, it's something you got to look at the whole overall picture if you want to be sustainable.
Yeah, and this is when you have an area so contingent with employment to one particular, industry. So if there's no jobs there, what do people do? They all move. Right. And therefore, there's all that foot traffic that doesn't go into your cafes, your restaurants, your pubs, your dry cleaners, every other service there in those towns. So it can be decimated. But a lot of the purchasing decision, and Kevin, I'll finish with this point, is very much probably really understanding the supply and demand metrics. So, how do you actually identify properties that aren't going to hold you back for the moment in time that you're in, but with an eye towards the future? What would you say, what would be your top tips around sort of due diligence and making sure you're making the right call on these things?
Yeah. So if you're buying it, especially in a heated market, you hear about off-market deals, all this stuff all the time.
Is there such things as off-market deals?
There is. Well, for our definition is anything that's not publicly or listed on the major portals.
Pre-platform.
Domain real estate, right?
Yeah.
So sometimes you can get an off-market through an agent and it's exclusive with just yourself.
Yeah.
Right. Other times there might be a few other people.
So let's talk about that really quickly. How does that work? So an agent will get a listing from someone that wants to sell their property, and typically good agents, rather than sort of putting it into the public platforms first, they'll have a whole bunch of buyers agents and or other buyers they know are looking for it, and they'll try and sell it without having to list it.
Yeah, it's all about how someone likes to stand out or their niche. So I've got some agents in hot markets, and their whole thing is they sell off market.
Yeah.
Because one train of thought could be like, hey, it's a hot market. Why wouldn't I put it online to get maximum exposure? Good point. The other element is, hey, it's a hot market. Why do I need to put it online? Because there's plenty of demand already, right? So I've got agents that do that. And it's something you got to watch out for though. If it's off market, you don't actually know how motivated the seller is. Because if it's online, they paid for marketing, photos, all this stuff. You know that they want to sell. Yeah. Right. If it's off market, you don't know if you're a pre-market, test bunny. You don't know if they don't know if they've even signed the agency agreement with the agent. There's all these things that you need to uncover a bit more. You know, so
a lot of agents will actually go and secure a listing by saying, "I've already got these buyers squared away. You sign with me. We'll get it sold pretty quickly." But to your point, you could just be testing the market for them to set a price point to better sort of help them secure a listing, and then they'll take it to auction. Yeah, so these are the games that agents play.
Yeah, these are all the things that you need to ask and understand that happen in the industry, and you need to best protect yourself, whether you use a buyer's agent or you do it yourself. But
that could be quite fatiguing and frustrating though when you get in those sort of games of they call them negotiation tactics that real estate agents play. That's why a lot of people who don't use a buyer's agent, they just get absolutely fatigued with it and they invest all their time, energy and effort into the first deal, falls down, second, third, fourth. By the seventh or eighth time, they're just done with it and they go, I'm sick of it. I'll use a buyer's agent, right? It happens all the time. You must get clients like that.
Yeah, that's right.
Nice one. That's good, Kev. Well, hot prediction for the next financial year as we sort of end 2025 and move into 2026. What's going to happen in real estate markets?
I reckon interest rates are going to continue to come down. That's also my personal prediction. The two things that will come out of that is markets that are highly leveraged, like a lot of Sydney markets and say Canberra and stuff like that. They're going to do well because people get relief there the most. In areas also where there's been really tight supply, but the demand isn't too crash hot, like namely a lot of Victorian and New South Wales markets. We're probably going to see a bit more spike in demand there, just naturally based off the sentiment and confidence. So
you mentioned the Fast 50 report, which you can download from smartpropertyinvestment.com.au, where to put your money today for the best capital growth in 2026. There's a lot of Victoria markets in there, which is pretty much like everyone going, there's nothing going on there at the moment. There's probably going to be accelerated growth in certain areas, but not all areas in Victoria are going to grow. Right, I think you need to be very specific and disciplined. So how do people track you down, Kev? What's the best way to contact you if people want to sort of just chew your ear and, shape and determine how best to invest in property or even use your services? How do you find you, mate?
kevtran.com.au. That's KEVTRAN.com.au, or find us on Insta, Kev Tran Group.
There you go. Well, thanks for coming in, mate. Always enjoy it.
Thanks,
it's always good, that discussion. Please, everyone, if you like what we're doing here, keep those reviews coming, whether it's on Spotify or on Apple, or if you're watching this on YouTube, just a thumbs up, subscribe, and tell your friends. Leave a comment even. I'll be like that sort of stuff. smartpropertyinvestment.com.au. You can also get the Fast 50 there if that's what you want to do. Social media, Smart Property Investment. You'll track us down. Thanks for tuning in. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.